Good morning, everyone, and welcome to today's webinar, Understanding the Numbers in Your Trades Business. Just a little bit of housekeeping before we get started. For those of you who are unfamiliar with the webinar environment, these are the Zoom settings. You can click Audio Settings here to select and test your speakers. You can submit any questions you've got throughout the webinar using this Q&A button, and we'll answer as many questions as we can at the end of the webinar. If you do need to leave the webinar at any time, just click this Leave Meeting button and you can rejoin the webinar by using the same link you used to get here. Once the webinar has finished, there will be a short survey that will pop up on your screen. If you could just spend a couple of minutes completing that for us, we read every piece of feedback we get and take it on board to improve our webinars going forward. First of all, I just want to explain a little bit about Roslin Associates. Our purpose is to help our clients build a better business and help them make more money, save time, and live a better life. We do this through our business development and coaching services, combined with our financial expertise as accountants and tax advisors. So who are the presenters today? Well, my name's Ikra Aslam and I am one of the client managers here at Roslin Associates, and I'll be taking you through the first half of the webinar. Then we've got Ian. For those of you who don't know him, he's one of the directors at Roslin Associates, and he'll take over from me about halfway through up to the end of the webinar. So before we get to the main event, I just want to share a thought of the session. The budget is not just a collection of numbers, but an expression of our values and aspirations. Hopefully, as business owners, you will have all updated your budgets and forecasts in the last year. These numbers express your aspirations for the business over the next 12 months. What I mean by that is if you were to imagine where you want your business to be in, let's say, the next 3 to 5 years, your 12-month forecast and budget is the first step to get you there. It's really important that you take the time to make sure that you understand, monitor, and measure what you've set in those budgets and forecasts. So this webinar is about demystifying the most common reports that you'll be seeing on a weekly, monthly, quarterly, and annual basis, so that you're in control of your business performance. So over the next 45 minutes or so, we're going to cover the importance of knowing your numbers, an overview of different reports, which you've probably seen before, especially if you or your accountant produces accounts, the difference between profit and cash, the key drivers of business value, and how to adopt best practice. We'll then outline some potential next steps for you to take to make sure that you truly understand your numbers. So do take plenty of notes today, especially any actions that you believe you should be taking in your business as a result of watching this webinar. Some of what we talk about might sound like a foreign language to you, but we will try our best to explain things as best as we can. So do send in any questions you've got throughout the webinar using that Q&A button, and we'll try and answer all the questions at the end. Okay, so knowing your numbers is vital because it allows you to interpret your reports and know if you're on track to achieve the goals set in your business plan if you have one. Before we take a look at the reports, I'm going to ask you some questions. What about your business keeps you awake at night? Just have a think about that for a second. Or even better, write it down. So what keeps you awake at night about your business? Is it lack of cash? Do you worry about how you're going to pay your team on payday, or your supplier bills? Or even if your HMRC debt seems to be increasing more and more? Do you feel like you have this never-ending amount of work that you need to get through? Is it the confusion of how you've made a profit according to your accountant, but you've got no cash in the bank that's keeping you awake at night? Is it lack of profits despite the fact that your sales seem to be going up? It could be that you've quickly grown your business over the last few years that you're now feeling out of control. Small business owners suffer from these and many other worries that keep them awake at night. So you're not alone if you wrote any of those worries down. How can we escape all of these worries? Well, the first step is to know and understand the numbers in your business. If any of you have watched Dragon's Den, I'm sure you will have come across a pitch on an episode where a dragon's not impressed if the entrepreneur doesn't know their numbers. But you're probably not going to take your business onto Dragon's Den, so why is it important for you to know your numbers as a business owner? Let me explain. As a business owner, you have to make a lot of decisions. For example, it could be around pricing products and services. It could be about recruitment if you need to take on new team members. It could be about purchasing new assets, for example, if you need a new van. To make good decisions, you need the right information, knowledge, and skills. Without the right information, knowledge, and skills, decisions are made on guesswork and emotions. Every decision on business has an effect on the short, medium, and long-term numbers. That includes your cash, your profit, and the value of the business. Making these types of decisions without knowing the numbers and how they work in your business is like driving a car without knowing what the road signs mean or what the various lights and indicators on your dashboard mean. Eventually, you are going to either get lost or have a breakdown. So the same applies to your business. Following on from that, here are the top 6 reasons why you need to understand the numbers. First of all, they tell the story of your business. So you can take a look at the figures from when you first started your business versus now and analyze any trends. It could be that your sales have grown from year on year. It could be that your gross profit has declined over the same period. Also, looking back at your numbers and being able to understand them can give you a reminder of how much you've grown and improved over the years, giving you the motivation to continue through any rough patches. Knowing your numbers helps you identify the symptoms versus the root causes. For example, a decline in gross profit is a symptom of many root causes, such as ineffective pricing, rework, poor purchasing, or even wastage. This is really important because you need to get to the root causes to actually solve the problem and not just treat the symptom. Knowing your numbers will give you the ability to spot any early warning signs as potential issues. For example, monitoring how long it takes customers to pay you allows you to quickly respond if that number starts to increase. So let's say if on average your customers take about 30 days to pay your invoices. If that number starts to increase over a few weeks and months, you can nip it in the bud and put processes in place to ensure that the average amount of days your customers are taking to pay stays within an acceptable limit. Otherwise, you'll start seeing a symptom of poor cash flow. Areas of strength and weaknesses will be highlighted. For example, your balance sheet indicates whether your business value is going up or down. Understanding your numbers also means you have reliable financial information to base your decisions on. And finally, knowledge is power. The more you know about your business, the better your business will be. So we're going to have a look at each of these key reports to help you understand why they are important and what you can learn from them. We'll work through an example to show key learnings and things to look out for in your reports. So we're just going to use a made-up company as an example. First of all, we're going to have a look at the trading account. So your trading account tracks your sales, variable costs, and gross profit to calculate the return you're achieving before deducting any fixed overhead costs. Your gross profit percentage indicates whether your margins are improving or deteriorating. This is a very important measure. It's often tempting to just focus on sales. However, it's the gross profit which is more important. For example, a £1 million turnover company, turnover is sales, with a gross profit percentage of 50% is less profitable than a company doing 800,000 in sales with a gross profit of 70%. If it suits your business, you can track your results across different types of work by using multiple trading accounts. For example, if you're an electrician, you might split your work into domestic and commercial. Having a trading account for each type of work allows you to track how each one is performing. The benefits of splitting it is to check the gross profit percentage for each type of work, because you will then be able to identify if one is making a loss, which you wouldn't know if they weren't split out. In this instance, let's say the domestic work is showing a gross loss. You might then consider to stop doing domestic work going forward and just concentrate on commercial. However, there are obvious implications within that, such as the fact that how long commercial invoices take to get paid compared to domestic ones, which may cause poor cash flow. That's why it's really important to understand all of your numbers and not base decisions on guesswork and emotions. Small adjustments to the items in your trading account can have a huge impact on your overall results, which I'm going to show you now. So this is an example of a fake company's trading account. As you can see, they had sales of just over 1 million, cost of sales of 318,000, giving them a gross surplus from trading of just over 700,000. Their direct costs were just over 450,000. So their gross surplus was 248,749, giving them a gross profit percentage of 24%. Let's say this company undertakes some coaching with their accountant and implements strategies to increase their customer retention rate, resulting in a 10% increase in sales. They also work with their accountant to review their inventory processes and reduce their cost of sales by 5%. They renegotiate their contract with their delivery provider, resulting in a 5% saving in their direct costs. As a result of these changes, their gross surplus has increased by 140,251, and their gross profit percentage has increased from 24% to 35%. Understanding your trading account allows you to identify areas where small improvements can have a big impact on the profitability of your business. It's really important to stress here that every business's trading account is going to look different. It also depends on your own specific business in terms of how your trading account should look. If you are unsure about your own trading account, please get in touch with us to see how we can help. So moving on to the profit and loss statement, it basically shows all your earnings and costs over the year and tracks the overall performance of your business in terms of whether the business has made a profit or loss for the year. It matches your income and expenses for the period, with adjustments made for timing differences. I'll explain what I mean exemplify that with an example. So when you look at your profit and loss statement, it will show you the sales that you have made in the year, even if those sales haven't been paid yet. That is one of the reasons why the profit and loss statement doesn't reflect your bank balance. That is why it is important to understand that profit does not mean you have cash in the bank. The profit shown in your profit and loss statement includes non-cash expenses such as depreciation. You must also make sure that you have sufficient profit to cover cash costs which don't appear on your profit and loss statement, such as the capital elements of any loan repayments, asset purchases such as vans, and your own drawings such as dividends. But Ian is going to talk further on the difference between profit and cash later in the webinar. It can be useful to think of the profit and loss statement as starting with the gross profit at the top of the page and then taking off your overheads. Overheads are expenses which don't generally increase if your sales were to increase, such as rent, admin salaries, IT support, light and heat. But of course, over time, they will increase if your business is growing. For example, you might need to take on more office staff or get a bigger office. Your profit and loss statement provides a framework to benchmark your results by using percentages or comparisons between years to compare your business performance to similar businesses. Businesses are generally valued using a multiplier of earnings. So your profit and loss statement is fundamental to the value of your business. So basically, the higher your earnings, the higher your value. So this is an example of a profit and loss statement using the same fake company we looked at earlier. We've taken the gross profit from the trading account and listed all of the expenses followed by the owner's salary to calculate the net profit or loss. So as you can see, the company is currently trading at a loss of over 113,000. So if it's got brackets around it, it means it's a loss. Let's say the company undertakes a review of all of their expenses with their accountant and identifies potential savings to be made to their insurances and rent. They contact an insurance broker and their landlord and negotiate a 5% reduction for both expenses. So they've saved £597 in insurance expenses and just under £3,000 in rent expenses. However, you'll notice that the accountancy fees have gone up. This is because the company took on additional business development services with their accountant. Despite the increase in the accountancy fees, the overall net profit has increased by 138,000 to 24,000 due to the savings. So as you can see in the two examples we've just gone through, the changes made to the figures were only in the region of 5 or 10%. And because of those changes, the company has gone from a 113,000 loss-making company to a profit-making company. Some of you might also notice that this enables us to work out the break-even point for the business. Basically, this is when the gross profit equals the expenses and overheads. In this case, before any changes, the gross profit needed is 248,749, this figure up here, plus the loss, this figure down here, of 113,858, which equals 362,607. We then need to gross up using the gross profit percentage to calculate the sales needed to break even. In this example, the gross profit was 24%, so the sales needed to break even are just over 1.5 million, when the actual sales were just over 1 million, and that's why this company is showing a loss. For a new business in particular, knowing your break-even is a vital number. Hopefully you can see how understanding this can make a huge difference to the performance of your business. I'm now going to pass over to Ian, who's going to take you through the rest of the webinar. Remember, if you've got any questions at all, please do pop them in the Q&A box. Over to you, Ian.
Right, sorry about that. Yeah, my microphone's working now, that's fantastic. What I was going to talk about now is the balance sheet. Now, if you bear with me, yeah, the balance sheet is a bit different. What Ika's talked about so far is the profit and loss account, and that measures the business performance between two dates. It could be a month, it could be a quarter, it could be a year. So income less expenses, and that's usually relatively easy to understand in principle. The balance sheet is something which, in my experience, clients often kind of don't really engage with because they don't really understand it. But it is important to understand it because it tells you how the business is doing and at any one particular point in time. So it provides a snapshot of the financial position. So it's not over a period, it's on a day. And it's one measure. Technical issues here. Right, sorry about that. It's one measure of the net worth of your business, which is your assets less your liabilities. So it's basically saying, these are all your assets, here are liabilities, and the net value is the value of your business, essentially. And the most common assets are things such as buildings, equipment, vehicles, cash in the bank, and unpaid sales invoices, for instance. And common liabilities would include things like loans made to the business, unpaid supplier invoices, people you've got to pay, and taxes, obviously. And the balance sheet also shows if your business is solvent. So if your liabilities, things that you owe, are greater than your assets, then the business is technically insolvent, and usually you have to do something pretty urgent to fix that. And you can compare different periods to see whether the business's net worth is increasing or decreasing between years. You know, are the assets increasing? You know, whether it's property or cash or whatever, are they getting bigger and your liabilities getting smaller? You know, you can look at those and track them from year to year. And the stronger your balance sheet is, in other words, the more your assets exceed your liabilities, the easier it is for you to survive any downturn because you've got value tied up in those assets. It's ultimately you can release to settle the liabilities and still have something left over. It also provides the basis to calculate some key ratios. And that could be things such as debtor days and inventory or stock days. Don't worry about that. I'm going to explain what these are in a minute. Okay, here's an example of the balance sheet of that fictional trade company we were looking at. And as you can hopefully see, that company is technically insolvent as it has more liabilities than assets. Its working capital, which I'll explain in a minute, is also a negative figure because its current assets, and these are things that would be converted into cash, are less than its current liabilities. So what that really means is that if the business was called upon to pay all these current liabilities, the 162,000, it could only reasonably quickly convert some assets into cash of about 138, which would be a shortfall. So that's a bit of a problem. So what can you do about it? Well, one of the things you could do is look at generating some cash from by looking at your debtor days. Now, as I said before, debtor days, sorry, I'm having a bit of a technical problem here. There we go. What we could do is we could basically implement some strategies to reduce the debtor days. Now, a debtor day is simply how many days of sales have you invoiced that haven't been paid yet, essentially. So it's cash that's tied up in the money that's owed to you by customers. So to calculate that, basically, you look at your trade debtors, and that's 72,000 there. Divide it by the amount of sales and multiply it by 365, and then you've got 26 days. So in this instance, the company is owed money for about 26 days worth of work. Now, if you could improve that by 5 days, you can basically do some introduce some strategies, some procedures, some processes to your collecting of your bills. You could actually improve your cash position by £14,000. Maybe change your terms of trade, for instance, and then to do your inventory days, stock, that's the amount of stock you have to work out. So in this case, the business has 74 days worth of stock. Now, if that could be reduced by, say, 9 days, that would get you another £7,860 of cash. So while the cash flow gain of nearly £22,000 doesn't actually fix the solvency issue, it demonstrates how much cash could be saved with some help from the accountant. So the difference between profit and cash. Now, Ikra touched on that, and it is quite a common thing, having a meeting with a client and finding they made £80,000 profit, say, and they look at their bank account and there's nothing in it. And it's really hard sometimes to understand why that is. And it's also true that a profitable business can go out of business because it's starved of cash. And the other side of that is a business running at a loss can survive if it keeps getting access to funds from investors or banks or wherever. It will obviously not long term. If anybody was at our webinar a few months ago on cash flow management, there was a couple of examples in that showed how one business which was making a loss managed to survive, at least for a while, and the other one which was making a profit went out of business because it didn't have any cash. So turnover is vanity, and as Ikra touched on earlier, the idea that if you make £1 million, that's great, but it depends on how much profit you're actually making. It's almost easy to make a turnover increase, but to make a profit increase involves a little bit of more financial intelligence, I suppose is the word. And even making a profit isn't the end of it, because you can do some work, you can issue an invoice. If you don't actually get paid, then the profit might as well not be there. So cash flow is the reality. So what I'm going to do now is a little quiz. The answers, we've already given you some of these answers, well, Ikra did earlier, but I'm going to take it relatively slowly so that you can write down your answer and see if you know you've got it right. And I'm not going to ask anybody to share their answers. So what we're going to do is look at a few items and see whether they affect your profit or your cash or both. So how about your VAT bill? When you pay your VAT bill, does it influence your cash or your profit or both? It affects your cash because your profit is calculated on your net of VAT figures. So your net of VAT sales and your net of VAT expenses. So when you pay the VAT, it definitely does affect your cash, but it has no effect on your profit. What about loan repayments? And what I'm talking about here is the capital element of the loan repayments, the amount that actually reduces the loan that you owe. Well, again, that affects your cash. You have to use cash to pay the loan repayments, but it doesn't affect your profit. It's simply a balance sheet transaction. It doesn't affect your profit. So it can be a drain on the cash, but your profit's still sitting the same. Interest on loans, what about them? Well, it affects both, because the interest on a loan is the cost or the expense of borrowing the money. So it is an expense, so it does affect your profit. And it also affects your cash, because you have to use cash to pay the interest. But asset purchases, and I'm keeping it simple, saying a cash purchase is a clue. Does it affect your profit or does it affect your cash? It affects your cash. You spend money to buy a van, say, or some equipment, but it doesn't affect your profit. An asset sale, if you sell an asset, does it affect your cash? Does it affect your profit? Again, it affects your cash, you get some cash in, but it doesn't have any effect on your profit. And what about depreciation? One last one. Depreciation obviously is the writing off as an expense the cost of an asset over its expected lifetime. Well, depreciation affects your profit, it reduces the profit, but it doesn't affect your cash. The cash went out when you bought the asset. Depreciation is just the expense being written off over time. Okay, moving on, the Business 101 cycle. It's another useful way to demonstrate the difference between profit and cash. And it's really just a model of how the business operates and generates cash. So the first thing is the owners need to invest some money. Now that might be very small scale. It might be the day when you decide that you're fed up with your job, you hand in your notice, you say, right, I'm doing it myself, right, okay, I need some tools. I need to buy some tools, I need to buy a van possibly. So the money you put in is used to buy assets. And you might need some loan finance because you might not have enough cash, you might have enough to buy the tools, but not the van, so you borrow some money there. These assets are then used to generate a profit. Pretty easy. Now you can increase your profit at that point by selling more and having better margins. What drains on the profit there are unchecked overhead expenses. So, you know, if you start buying things you don't need for the business, these sort of things, that can reduce your profit. So you've invested money, you've bought your tools in your van, you've done the work, you've invoiced it. The next step is when you get cash. That is when your customer pays you. Now, what slows down getting paid? Well, first of all, obviously, not having a decent procedure in place to collect money from people that owe you. So you raise your invoice and you wait and you wait and you wait, and I've seen that quite often. Second thing might be increasing stock or work in progress. In other words, buying too much stock and holding it when you don't really need to, or also maybe doing work and not invoicing soon enough. That can have effect on your cash. Business loan repayments, if you borrowed to buy a van, say the second step in the cycle, then you might have to pay that back. You might be starting to make loan repayments. Tax payments, you've made a profit, eventually you're going to start paying some tax, and that could be a drain on your money. And then faster payment of suppliers. So if you pay your suppliers too quickly, then that's a drain on your cash. Now, often when a business starts, you don't have an option. You go along and you pay cash for your materials. But as time passes, you should be asking for credit, maybe 30 days and eventually maybe 60 days. So you're slowing down the payment of your suppliers legitimately, and you're retaining more cash in the business. Gains, faster collection. So, you know, have a system in place to get paid quicker. Maybe even have handheld card payment machines so that, say for residential type work, you could be getting paid on the day. I know people who are doing that. Again, the opposite of increase in stock of work in progress, decrease in it. Don't buy too much stuff, don't have anything lying around you don't need. Paying your suppliers slower, like I mentioned, and reduce tax payable, which is something that we specialize in, and making sure that our clients don't pay any more tax than they have to. And finally, after all that time, eventually, if you get the cash in and you manage to hold on to it, you can take money for yourself. And you might use that for personal loan repayments or just money to live off. it's a whole cycle, and the idea is to speed up that cycle as quickly as possible to be able to get that generate more and more cash for yourself and your family, etc. Okay. So after cash flow, the value of the business is often the next most important measure of business success. So part of knowing your numbers is understanding and measuring the drivers of the value of your business. And for trades businesses, these are typically the ones shown on the slide. These are sales. Obviously, if you don't have any sales, you don't have any business at all. Gross profit percentage, and as Ikra mentioned, that is as important as sales. The next three are cash flow items. We've looked at debtor days, even on the technical problems we were having. We looked at debtor days. If you can reduce your debtor days, in other words, have fewer days work unpaid, that will help your cash. Creditor days, the reverse, if you can increase that, that keeps cash in the business. And the same with stock, if you can decrease that, that helps. And obviously net profit. And these are things that can be measured on a regular basis. You know, you can put in systems to track your sales, your gross profit percentage, debtor, creditor, and stock days, and net profit. And if you, at the end of the day, accounting is arithmetic. If you state what you want the profit to be, and you know what your sales, the gross profit, and all these other things are, you will be able to hit your targets as long as you monitor them regularly and make any changes that you need to make. So, to enhance the value of business, you first got to develop and implement a clear plan. If you haven't got a plan, you could end up anywhere. So you really must have a plan to show where you're trying to go, and a lot more. I'll talk about that in a minute. You should really document, if your business is big enough, you should really document the organizational structure and the roles within your business. That gives a solid foundation for growth, because what we often find is once a business starts, it grows and grows and grows, and almost organically, and the business owner keeps most of it in their head, and it reaches a certain point, and often it's between, say, 300,000, 500,000 turnover, but you know, it could be either side of that as well. Reach the point where the business can't grow anymore because things start to fall and the business feels stuck. So the typical symptoms that we see are sort of total lack of clarity as to who's doing what and when, etc., and also completely stressed owners who really are trying to hold it all together. So an organization structure with clear roles will help that that ability to move away from reliance on the owner. Establishing cloud-based real-time reporting. Now that's a game changer, I suppose, over the last 10, 15 years. In the old days, accounts or bookkeeping were kept on desktop computers, and essentially it was very hard to get access to it all on a regular basis. Nowadays, with software like Xero, you can access it. Anybody can access it. It's got a username and password. You can get in, can make changes, can take reports, see how things are. And it also means that we can take data out of Xero and create reports that are customized exactly to what clients want and need for their business, and then use that to steer the business forward. Again, having systems and processes is totally valuable, because by having the systems and processes, the business can then go along without reliance on the owners, because the owner can go on holiday, come back, and it's still there. I've spoken to people in the past who said they can't take a holiday because they didn't think the business would continue if they went away for a few days. If that means the business is not worth very much if it needs that much input from the owner. Would you buy a business that relied on the owner to that extent? And also identifying and managing risks. And I'm talking here really about financial management and risks. I was working with one client and we identified that there would be a cash flow issue in 9 months' time because of certain circumstances. So they could then plan and take some action to make sure that it didn't cause them a major problem at that time. That's so much better than, you know, only knowing you've got a cash flow problem when you log into the bank in the morning. So how does everything I've talked about kind of come together as best practice? Well, I think every business should use the 3 essential tools as follows. An annual business plan, which is an annual sit down for best part of a day to look at where the business is, what the business values are, who your ideal customers are, what you're trying to achieve in your business, what you want out of your business, what the numbers should look like, and any steps that need to be taken, broken down from 3 years time to 90 days or even 30 days. An annual forecast. First, the forecast can be a reality check for the numbers in the business plan, but also it can be used with cloud-based accounting to then create reports and comparisons between to track how you're doing compared to what you said you were going to do. And that allows the ongoing reporting that and accountability means that with clients, you sit down and we look at the numbers and we look at what the business is doing on a regular basis, make action points, review those at the next meeting, make sure things happen. So knowing your numbers is just the beginning of the process. So what's the next step? Now, our aim is to help you take what you've learned today and implement some positive change in your business. It's time for you to decide where you're going in your business and what you're going to do. Take a few minutes after the webinar to write down 3 actions or projects that will add value to your business. Use the information you've got. You'll be getting a recording of this, and use that information to decide what actions projects you will take. And maybe it's your debtor days. Maybe you need to look at that. Now you know how to do it. You can look at your accounts. You can impress your accountant by saying, look, there's my debtors, there's my turnover, my debtor days and such and such. So what problems are you experiencing in your business just now? Use those problems as an opportunity to create a project to fix them. And doing nothing should not be an option. Just a quick slide of what we can do. So now you know what you should be doing. Here's how we can help you if you need help. If you don't currently have a business plan, we can help you develop one. We can also create an updated financial forecast, which reflects the results you want to achieve in the next year. For those of you who need to be held accountable to complete your actions, which are quite a few in my experience, we have a range of coaching options depending on the frequency that suits you. It could be monthly or quarterly. And obviously we know that it might be difficult to commit to spending money right now, but all of these services do include an assessment as how we can improve your profitability and cash flow. So it'll be a great return on investment from this process over time. In the short term, we've got different payment options available, so please don't let cost be a barrier. Get in touch and we can work together to come to some sort of arrangement we can manage. I should also mention that the complimentary meeting is free. And that is a starting point to help you identify what you need to do in order to achieve the business goals that you want. And just one thing hot off the press is we have an ebook for trades on our website. If you go to rosenassociates.co.uk and go to the trades page, you'll see there's a book that you can download, which covers 2 things. Some of the stuff we've talked about today, the numbers, the important numbers, it explains it in a bit more detail if you like to read stuff, as and also it covers mindsets in terms of what mindsets a business owner really needs to have in order to be successful. So go to the website and you can download that for free. And that's it. So I was going to ask Ikra if we have any questions.
Yeah, we do have a couple of questions that have come in so far. So if anyone else has got any other questions, please just put them in the Q&A box and we'll get through them.
Okay.
First question we've got here. Thank you for today's webinar. I learned a lot. As business owners, how are we expected to learn all of this?
Oh, that's a good question. Well, hopefully today has been a first step in that. But what we find is that we, as we work through over time with clients, a significant part of what we do is not just telling them what to do or helping them improve their business. It's actually educational. So in fact, we had one client just last week who we were going over the financial reports, and he pointed something out, and he clearly had grasped the importance of knowing his numbers. And in fact, we had a laugh because he said, basically it's a student turned master, he'd really taken it. So I would say, there are books you can read, obviously, if that's your thing. But when we work with clients, we educate them as much as we do anything else. Okay.
Yeah. Got another question here. When is the best time to start working with you on business development?
Well, I'm tempted to say now, but to be serious, I suppose, I think probably now is the best time to start talking to us, but the best time to start usually, ideally, is shortly after a year end, when you've already got your accounts finalized, because then we've got good numbers to start with. I mean, that's an ideal situation, but we can actually start working anytime, because we can actually create a budget to your year end and work with that if we have to. So yeah, there's no bad time, but there are sometimes they're a little bit better than others, I would say.
Yep, just got another question that's just popped in. How do I know how much I can take out as dividends?
Right. To pay a dividend, you have to have an after-tax profit. So essentially, the way to, there's different questions there, I suppose. The technical one is what I've just said. You have to have a profit after corporation tax and that you can distribute. The practical one is to have good recording systems, financial recording system, keep it up to date monthly, make sure it's accurate, put in the provision for corporation tax and depreciation in your accounts, and then your retained profit should be accurate, and that's what you can take as a dividend. But you'd also have to look at how many shareholders there are. Are there other classes of shares? What other income do you have? Looking at the tax aspects of it. So there's a lot to look at, but to know what dividends you can pay, you need to know what profit the company has to distribute. Hope that makes sense.
That's all the questions that have come through. If anyone's got any more, you can pop them in the box. Wait a couple of seconds to see if anything pops in. Don't be shy. I think that's all the questions we've got for today.
Okay, well, thanks everybody, and I hope you enjoyed the webinar. Apologies for the slight technical issue I had halfway through there. These things always happen now and again. And when you leave, there's going to be a short survey. Just bear with me. And, yeah, so it's a brief exit survey. We really want to improve our services and make these webinars as relevant as possible. So if you wouldn't mind filling it in, just taking a couple of minutes just to fill it in, that would be really appreciated. And we do hope you've given you plenty of ideas to ponder and some clear next steps for you and your business. Thank you.
Thank you.